Okay, so I'm audible to you, right? Please confirm, is the audio and video clear to you all? Yes? Okay. All right then. Very good morning. Welcome back to this session of editorial analysis, finance and economy editorials. First of all, yesterday the class didn't happen because there was no editorial related to finance or economy which I could find relevant for you, or there was no such editorial, first of all, in all of these newspapers which we cover usually, right? So you didn't miss up on anything, so don't worry about that. It's just that there was nothing to discuss about. Okay, very good morning. Namaste, good morning. Okay, so all right, today out of all the newspapers, I have picked up one article from your Mint. Okay, so this is from your Mint. You can read this article. RBI has been managing liquidity in challenging times. So this editorial is in your Mint newspaper. If I talk about Hindu, there was nothing. In Indian Express, there was something related to inflation, but overall it was really a data that what should the government do to control inflation, right? So more oriented towards elections. All right. Again, in business line as well, you had editorial which was talking about the same thing which we have discussed, the SEBI's new unaffected price regime, right? So we have already discussed the unaffected price regime, so I didn't take it up so as to avoid the repetition. So overall, this was only the relevant article which I could find today, and it's very interesting. It is combining two contrasting situations of Indian economy which you would be very excited to learn about, right? Okay, afternoon हो गया. Yes, afternoon हो गया है, but you know, जब भी आप पहली बार किसी से मिलते हैं तो you wish good morning only. When you meet someone for the first time in the day, be it afternoon or be it evening, it's generally, you know, greeted as good morning. That's why. So don't drive me into the details of such things. Okay, let me focus upon the editorial only. All right, so this is your editorial. The editorial has been taken from the Mint, and I have explained you that why have I chosen this. And RBI has, so title is RBI has been managing liquidity in challenging times. Okay, RBI has been managing liquidity in challenging times. This is the title given by the author, but my title is liquidity and the slope. So after completing this analysis of this session, you will be able to understand why have I put this heading liquidity and the slope. Okay, first of all, let me make it clear to you. A slope and a liquidity are very interrelated, right? For example, water flows according to the slope. It doesn't flow against the slope. Yes or no? So I have chosen this title to make you understand that liquidity in Indian economy is changing its slopes. Why am I saying that? Because you know, there have been times when government's liquidity was very strained. You all agree about that, right? And banks' liquidity was in good shape, for example. Although the liquidity in banking system keeps on changing, but the liquidity of the government cash balances are often strained. But what is different which is happening in Indian economy, as you can see right now, government is having extra cash balances, or I'm not saying extra, but yes, liquidity is improving on part of government. There are various reasons behind it. First thing is that, you know, election mode is going on, so model code conduct going on. Due to MCC, government spending has reduced. First thing, you all know that there are certain limitations on the expenditure of the government which the election commission requires during model code of conduct. Yes or no? Right, so first thing, it has reduced the spending of the government. Second thing, as you all know, we have discussed in detail, RBI has transferred surplus of how much? 2.11 lakh lakh crores to the government of India. You remember that? 2.11 lakh crores. You should remember, right? So this has increased government's revenue, okay, or funds available with the government basically. These are the things that are changing slopes in the Indian economy with regard to liquidity. So now the editorial talks about that the government is having surplus or say cash balances and the banks are managing with the liquidity, and the entire story lies in between, and how RBI is trying to manage this liquidity in challenging times. So you know that RBI tries to balance the liquidity in the banking system. So how RBI is doing that, okay? So this is the editorial which is there. Let's see what it talks about. Yes, dividend. Okay. So first thing, the country's money market, the author says that country's money market is very sophisticated today. First thing which the author says is that at present, if you see India's money market he is focusing upon, okay, it is sophisticated, it is complicated. You cannot have clear-cut distinctions regarding to money market of India at present. Why? What is the scenario? We'll understand in the later course of time, okay? So the author is saying that the country's money market is very sophisticated today with the Reserve Bank of India's liquidity framework now targeting the call money rate. So this is actually the headline. Sophisticated means complicated, okay, which is not easy to understand, which is complex. Yes, all right. So this is basically the catch. Are you able to get this? What is the catch? That why RBI is targeting the call money market, particularly the money market liquidity, right? So this is not English vocabulary class going on. So please focus on editorial analysis, right? Okay. So the catch is that RBI is targeting I am telling you what is call money, what is money market, okay? I'll explain you. So first thing is that RBI is targeting money market and particularly the call money market. Now you need to understand what is a money market. So this is the headline and we'll proceed from here. The analysis lies on this particular point. Is this clear to you all? So first thing should be clear that the analysis is going to move around this point. Now to understand the entire analysis, you should know the difference between money market and capital market. Do you know the difference? When we say money market, what do we mean? So what is the difference between your money market and capital market? Anyone please? Anyone wants to tell what is the difference? Capital market is money short term and long term. Okay. So short term and long term what? Short term is money or long term is money market? See, short term money market basically deals with all the loans which are there for the short term, and your capital market deals with the loans for the long term. Now when I say short term and long term, we mean 1 year and more than 1 year, right? So money market broadly deals with your loan amount, whatever the means of loan is, okay, whatever the instruments are, for example certificate of deposits, commercial papers, mutual funds, but they should be for maximum period of 12 months, say 1 year or less than 1 year. Yes. So have you understood the difference? Money market is broadly where the loan is given and taken for less than 1 year, okay, say 365 days or less, right? Another one is your capital market. Capital market deals with long term securities like your share market, stock market, bond market. Why do we include bond market in capital market? Bonds are for more than 1 year, yes or no? right? So this is the difference between money market and capital market. Now in money market you have a lot of instruments which are there, proper instruments which are used for debt raising. For example, you have certificate of deposits issued by banks, your financial institutes, all India financial institutions, etc. You have commercial papers, you have GSECs, you have mutual funds, okay, you have repurchase option. All these things are your money market instruments. Why? Because they are dealing with your loan amount which is there for the maturity period of less than 1 year. Okay, so when we say money market, we mean short term loan, and capital market, long term loan. Okay, is that clear? The difference between money market and capital market? All right. So this is it, that RBI is basically targeting the money market under its liquidity framework. As you all know that RBI has a proper liquidity management framework. Okay, it tries to adjust the liquidity in the banking system through various policy rates and all these things, adjusting everything according to the requirement, right? And particularly it is targeting the call money rate. Call money rate. Now, do you know what is a call money? So you have understood first of all what is a money market and why RBI is trying to manage the liquidity in the money market. So this is the news. Now, particularly targeting the call money rate. What is call money? Anyone? What is call money? Call money. For less than 1 day lending takes place. Yes. Okay, so firstly you understand that we take loans from the banking system, from the commercial bank. Okay, that is different, but commercial banks also take and give loan within or among the banks. Are you getting this point? So basically this is known as interbank transactions. Banks also extend loan to each other in case of liquidity crunch. Are you getting this point? So interbank transactions, for example SBI and ICICI. Okay, so ICICI taking loan from SBI, that would be interbank loan. Are you getting this point? Interbank loan or interbank transaction, interbank loan basically. Is this clear? Now when we talk about interbank loans, the money is divided into 3 categories. Here comes your concept of call money. Okay, so we are talking about interbank. Call money is not related to your public borrowing or borrowing by the common people. Is this clear? So it is related to your interbank borrowing, one bank borrowing from the other commercial bank, right? So interbank का जो loan period होता है, the loan term during interbank loan offering, it is basically divided into 3 categories. First is your call money. Okay, you can note it down if you want to. Then next is your notice money, and next is your term money. Call money, notice money, and term money. Okay, call money is basically for 1 day. Notice money is for more than 1 day but less than 14 days or maximum up to 14 days. Okay, so you can say 2 to 14 days. And then your term money is for more than 15 days but less than 365 days. Are you getting my point? Because this is money market, so it cannot be for more than 1 year. So more than 15 days you can remember. This is the categories which you have. So call money means your overnight transactions, okay, 1 day transactions. Notice money is for your 2 to 14 days period of time, and then comes your term money for a long term which is more than 15 days. Is this clear to you all? So this is interbank offering of loan among the commercial banks themselves. So this is what we mean by call money. Bank offering loan to the other bank for 1 day period of time. That would be call money rate as well. Clear? Okay. You can take a screenshot or can write it down. You should remember these classifications: call money, notice money and term money. Now coming back to the news. So basically, why RBI is targeting the call money rate? Because they want to manage the liquidity in the money market as well. You know that the capital market is regulated by whom? Who regulates the capital market? Who tries to manage the liquidity in the capital market? Tell me the answer. SEBI. Very good. Because it is broadly the financial market which you have. Very good, right? So SEBI's decisions would be influencing the flow of liquidity in your financial market or capital market. But when we talk about the money market, we have the banking systems, the certificate of deposits, commercial papers issued by banks, financial institutes. So in that case, RBI has to intervene. So RBI is also trying to manage liquidity in this market. That's what the editorial talks about. Okay. So now you have understood this point. Now let's continue the discussion. Second thing that the author says is RBI has brought a lot of dynamism to the money market. So the author is saying that RBI is including lot of dynamism, lot of variations in the money market. How? With an array of tools being used to manage liquidity and bond yields in a non-disruptive manner. So basically, new tools have been used by RBI. As you know that RBI has also tried to adjust or say reform in particular its liquidity adjustment facility. I'll discuss about it in detail. Okay, so we will come to this point again. I'll explain it to you. What is liquidity adjustment facility? How does it affect the entire liquidity in your banking system? So RBI is basically introducing new tools, trying to manage the liquidity through new ways in the money market. This is what the author is saying, and that too in a non-disruptive manner. This is important, that it is not disrupting the working of your banking system. It is not disrupting, okay, rather it is helping them only. Now the call money market, which we have recently discussed, author says that it is the ultimate refuge for the banks to manage their surplus and deficits after exhausting all other options. So as you all know that banks have options to manage their surplus and deficits with the help of RBI through repo and reverse repo. This is your first option, but you know that the repo and reverse repo are fixed by the RBI. So what if the bank has to find some other way? In that case, you have the call money market or interbank offering of loan, right? So for example, say SBI has surplus funds. So SBI, apart from RBI mechanism of repo and reverse repo, SBI can give loan to another commercial bank for 1 day, which is call money, for 2 to 14 days, which is notice money, for more than 15 days, say, which is term money, right? So that they can manage their surplus, and the bank which was running into say deficits would get funds, isn't it? So this is your ultimate refuge for the banks to manage your excess and deficits, surplus and deficits. Are you getting this point? Yes, that's why this market becomes very important. Have you understood till this point? We'll try to synchronize all these points, right? Now I'll explain everything, that how is it using these tools, what are these tools which the editorial or the author is talking about, everything, right? Now with its liquidity adjustment facility, LAF, RBI targets the weighted average call money rate to keep it in a range of 6.25 to 6.75. So basically RBI is trying to manage these call money rates so that they do not get lowered substantially, and they do not get increased very substantially. Otherwise it would affect the money market hugely, right? So it falls in line with the RBI's monetary transmission guidelines. Are you getting this point? So whatever the decision is taken by RBI's monetary policy committee, say decision regarding repo, reverse repo, all these things should not get affected by these call money market rates. So these fluctuations should not affect the RBI's monetary transmission aim to the consumer, to the market. Is this clear? Now let's understand how does it happen. So you need to understand that RBI is managing liquidity in the banking system or your money market with the help of LAF. You know what is LAF? Liquidity Adjustment Facility, LAF, okay. So Liquidity Adjustment Facility, right? The liquidity adjustment framework being pursued by RBI deploys VRR, variable rate repo, and VRRR, variable rate reverse repo, to balance liquidity. Now let me explain this phenomena to you, otherwise you won't be able to understand how does it do that. So we have to discuss some basic concepts. First, you all know that there is a key policy rate. First of all, that there is a key policy rate. Okay, very good. I know you must be knowing the key policy rates and all. Let me explain the picture behind them. How do they affect your economy or money market? Okay. Now, see, you know something called as repo rate, right? Understand step by step, okay? You know what is the repo rate? Repo rate, or it is also known as your key policy rate, because it is the key rate and other rates are linked to repo only, right? What is repo rate? So repo rate is basically the rate at which commercial banks borrow from RBI for a short period of time. Yes or no? So RBI gives loan to the commercial banks for a short term. RBI gives loan to your commercial banks for short run. SR, short run, okay. What do we mean by short run? 1 day, but 1 to 90 days it can be, right? Although repo is particularly, repo actions are taken for 1 day, but by short term we mean 1 to 90 days. And then there is another rate. For a long term, you can get the loans from RBI, but that would be on the bank rate. Okay, so bank rate is also same. It provides loan from RBI to the commercial banks, but for a longer period of time. And since period of time is longer, the interest charge in the bank rate is higher. Bank rate would always be higher than your repo rate. Is it clear? Long term repo operations, yes. I am telling you that there are something called as term repos for 7 days, for 14 days, for 28 days. We will explain, we'll discuss everything. Just follow these things step by step so that you understand the entire mechanism, okay? I'll come to every point, right? Now, first thing, repo is clear to you all, also known as your key policy rate. Key policy rate. Now, why is it called repo? You need to understand that it's not a mechanism like the mechanism of you taking the loan from commercial bank, or we take the loan from commercial bank. Why? We get an interest rate offered by the bank, but it is not the case in repo. Repo is also known as your repurchase option, as the full form, right? Repurchase option. Repurchase option. So the mechanism under repo through which commercial bank can take loan from the RBI lies like this. You have government securities, so banks have government securities, okay. So under repo you have to place government securities as collateral. Are you getting this point? So you give government securities or you sell government securities basically to RBI, okay. So you have GSEC and you place it with RBI, against which you get the loan. So basically, suppose you sold the government securities to RBI, RBI purchased the government securities from you. So RBI gave you money, isn't it? Yes or no? Understood this? Now you have an agreement that you will buy back. So repurchase, you will purchase back your government securities from the RBI. That means you will pay back your money. Suppose this is for 10,000 rupees. You sold government securities worth 10,000 rupees to RBI, so you got 10,000 rupees from RBI, isn't it? Now you will repurchase it, so with some interest, say you paid 11,000, or apart from interest, just try to understand the mechanism, 10,000 rupees. So you paid it back by repurchasing. That's why the name repurchase option. This is the mechanism through of taking loan through repo by commercial banks from the RBI. Have you understood this repurchase option? What is it? Right? So this is how they take loan under repo. Now this is something which helps in injecting liquidity into the market, isn't it? For example, okay, we'll compare repo rate and reverse repo rate. First you understand the reverse repo as well. Once more, you didn't understand what is repo? So repo is basically repurchase option, okay? Repurchase option. Why do we call it as repurchase? Say it is the loan, give and take of loan in this mechanism is done through your government securities. There are government securities, okay, and government bonds, okay. So government securities can be categorized into two categories: the T-bills, treasury bills, and your government bonds, okay. So government securities have two categories: T-bills and government bonds. T-bills for lesser period of time, say less than 1 year, and government bond is for more than 1 year. Is this clear? Now banks have government securities. Under repo you can place or you can sell those government securities to RBI. So when you sell something to someone, you receive money, yes or no? Okay, so you receive money. That's how you got the loan. And when you repurchase, you go to the market and you purchase something, you pay back the money, right? So this is how the repo mechanism works. Now there is something called reverse repo rate. What is reverse repo rate? It is reverse of repo. So under repo you were getting loan from the RBI. Reverse repo you can understand in two ways. First, you can see reverse repo as loan given by commercial bank to RBI, first thing, or excess funds of the commercial banks parked with the RBI. Are you getting this point? So you can say that commercial banks are giving loan to RBI, or you can say that commercial banks are parking their excess funds with the RBI. This is your reverse repo. Everyone understood, right? Now why there is something called reverse repo? Because it allows the commercial bank to park their excess funds. Sometimes it might happen that commercial banks have extra funds, right? So in order to stop that extra fund or surplus going into the market, RBI sometimes gives more interest on reverse repo, for example, which has now been replaced by SDFR. So increasing the interest rate allows or incentivizes the commercial bank to park more funds with the RBI rather than giving loan out of it into the market to control the inflationary situation as well. To absorb basically, yes, excess liquidity. Yes or no? Why does RBI do that? You know, RBI has to manage the inflation within the desirable brackets. So if there is more liquidity already in the market, you cannot allow banks to lend more or inject more liquidity into the market. Otherwise, inflation will increase. You will have to manage the inflation only through your monetary policy. Yes or no? So that's how through RRR or reverse repo, RBI tries to absorb the liquidity by offering higher interest on the excess funds parked with RBI by the commercial banks. And through repo, it tries to inject liquidity during time of deficits of funds in the market. Are you able to understand the difference between repo and reverse repo now? Just let me know so that I can proceed further. Yes? One is injecting liquidity, other one RRR is absorbing it from the banking system, from the market, or from the say economy, right? Okay, so we can say that RR injects liquidity, while reverse repo rate absorbs liquidity. isn't it? But now the picture is somewhat changing here. How? As you all know that RR, these are for basically 1 day, okay? RR and reverse repo rate are basically for 1 day. But what about the terms, or say long terms transactions? What about the long term liquidity? If say RBI needs to manage liquidity for 7 days, for 14 days, for 28 days, then you have term repo. Repo basically is meant for 1 day, but you can have term repos depending on the term of the loan. Are you getting this point? Say for 7 days, for 14 days, for 28 days. Yes, Ritik, can banks get repo loans apart from G-Secs and treasury bills as securities? Yes, they can, but then terms and conditions apply there. Okay, so you have option of marginal standing facility. Okay, that can happen, but then you have certain conditions applied over there, right? For example, can you use your SLR securities or not? So there are these minute points there which we can discuss in some other classes. Okay, although yes, there are options. You have marginal standing facility for which is there for emergency funds. Okay, all right. Now, so apart from 1 day transactions or 1 day liquidity injecting and absorbing, which is your RR and RRR, RBI has introduced variations, or say variable VRR and VRRR. So here basically what is known as your long term repo operations, right, in which you have 7 days period of repo, 14 days period of repo, 28 days period of repo. So that liquidity management is for a longer term, more than the 1 day. Is it clear to you all? So again, coming back to these slides, when we say that it is managing this liquidity through variable rate repo, and variable rate reverse repo. Now do you understand what is the difference between original repo rate and variable rate repo? It is just the difference of the time period. Say repo rate is injecting liquidity into your market for 1 day. Variable rate repo injecting liquidity for say 7 days period of time, 14 days. So it has different windows under it through which you can take loan. You means commercial banks. Are you getting this point? And again for reverse repo, you have again variable rate reverse repo. That can also go beyond 1 day. So this is basically managing liquidity for more than 1 day. Is this clear? This is what your VRR and VRRR is. When did the RBI introduce it? Variable rate repo and variable reverse rate repo. So it is nothing, the same concept, but only change in the or say more availability of your loan under repo for more days, say 7 day window period, your 14 day window period, right? 2021, 19, okay. So broadly you can see 2020 should be the answer, right? It got implemented in 2020 only. You can go and confirm, by the way, right? You need not worry about the year and date. That is not very important. What is important is that you have got the concept of variable rate repo and variable reverse rate repo. So it is allowing the RBI to manage liquidity for broader period of time. Otherwise the entire mechanism is same, isn't it? So it is providing more space for liquidity adjustment, right? So now you have understood this thing. This mechanism is known as your liquidity adjustment facility, in which your liquidity adjustment facility, so you have floor of this facility, which is now your SDFR, standing deposit facility rate, and your repo rate. Are you getting this point? So repo rate is the key policy rate. Okay, what will be the floor of this liquidity adjustment facility? SDFR, standing deposit facility rate, standing deposit facility rate. As you all know, Reverse repo has now been as a floor. Otherwise, earlier the liquidity adjustment facility had two ends, repo rate and then your reverse repo rate. Okay, so one end was your repo rate, injecting liquidity into the market, and other used to be your reverse repo rate, absorbing liquidity from the market. So it had two ends. But now, after introduction of SDFR, so SDFR has replaced your reverse repo rate as the floor of the liquidity adjustment facility. Is this clear to you all? So now this is another end. This is what is being used by RBI to absorb the excess liquidity from the market. SDFR, Standing Deposit Facility Rate. What is it? So earlier, in the reverse repo, basically you had government securities. Okay, you had to place collateral. Now in SDFR, Standing Deposit Facility Rate, you can park your excess funds with your RBI, okay, with higher interest rate as compared to RRR, and that too without any collateral. So the highlight of SDFR is that it is without collateral, without any collateral required in this process. So that's why your answer, Ritik, that is there any mechanism of, say, okay, so you asked regarding repo rate. Okay, repo, for repo also you can get without government securities, but there are different mechanisms. Under repo you have to place government securities, first thing. But if you want to take loan from RBI through other mechanisms like MSF, there are options. Is this clear? And under SDFR, when you place your excess funds with the RBI, you get higher interest rates. So this incentivizes the banks to keep their excess reserves with the RBI, and that too without any collateral. So collateral is not required in this process. This is the difference between RRR and SDFR. So just let me know, is this concept clear to you all? SDFR, very important, which is now being used by RBI to absorb the liquidity. So SDFR has now replaced RRR as your floor of the liquidity adjustment facility, the lowest end of your LAF window. Is this clear? Yes, no? Yes? Okay. Very good. Right? Now, so the author says that this liquidity framework being pursued deploys VRR, which is nothing but your repo for more than one day. You can have options of 7 days, 14 days and 28 days, and VRRR, which is your variable reverse repo, right, to balance the liquidity. In the first case, which is your VRR, RBI provides liquidity to the market. Yes or no? You agree? Injecting liquidity through repo rate, because it gives the loan to commercial banks, right? While in the later, which is your reverse repo, it absorbs the same. So same thing written and highlighted by the author. As I told you, that repo is used to inject the liquidity and reverse repo is used to absorb the liquidity. Same thing written over here, isn't it? Both of these operate on a relatively longer term basis. Now this is, you should remember, this is what you should remember, longer term basis. So what is the difference between original repo rate, reverse repo rate, and the new variable rate repo and variable reverse repo? Is the difference is that the variable rate repo and variable reverse rate repo is for longer term basis. So you can adjust the liquidity for a longer term basis, for say 17 days, for say 2 days, for say 3 days, right? So more than one. In RRR you can have 10 days, 3 days, 2 days as well. In RR or VRR, variable rate repo, you can have 7 days, 14 days, 28 days, like this, which is more than a day and can start from 3 days and go up to 14 days if not more. It can go beyond 14 days as well. So it is basically for more than one day. So VRR and VRR is for more than one day. Is this entire thing clear to you now? How does RBI manages? So these are the two things which are part of your liquidity adjustment facility, known as your liquidity adjustment facility. And the floor of this, the minimum which you can have in this is the SDFR. Okay, the lower end of liquidity adjustment facility is your SDFR. Clear? Very good. Now one thing which I want you to remember is you don't have to mug up the entire policy rates. Okay, you just have to remember what the key policy rate is, and that is your repo rate, because other rates are linked to key policy rates in a particular fixed manner. For example, if I ask you, do you know what is the present repo rate by RBI? What is the present repo rate by RBI? 6.50, right? 6.50. Now you don't need to remember other rates, you just need to remember the repo rate. You will find out the other rates automatically. How? You just always remember that your MSF, which is your marginal standing facility plus your bank rate. Marginal standing facility again for overnight borrowing. It is a facility for commercial bank that you can borrow in emergency cases overnight from the RBI. Okay, and bank rate, as you all know, long term loan taken from RBI. So these, because this is for emergency and this is for long term, they will always be higher than the repo rate. Are you getting my point? And they are always 0.25 percentage points higher than the repo rate. Okay, 0.25 percentage points higher than the repo rate. So that would mean that if you know that repo rate is presently 6.50%, what would be MSF and bank rate? 6.75, isn't it? So you need not remember them, you just, yes, 25 basis points or 0.25 percentage, right? And other thing that your MSF and bank rate. What about the others like SDFR? What is SDFR presently? SDFR, so your RRR now it has been fixed, I think it is 3.35. if you can check it on the official website of RBI and under the section of policy rates, right? 6.25. Yes, so it will always be 0.25% lesser than the repo. SDFR 0.25 percentage lesser than the repo, always. So automatically you can calculate it would be 6.25, isn't it? So you need not mug up all the rates, you just need to remember what is the present repo rate, and you know that SDFR will always be 0.25% less than repo, and MSF and bank rate will always be 0.25% more than repo. Why SDFR is less than this? Because it is the rate which is RBI paying to commercial banks. Why that would be higher than the repo? You know how a bank operates. If you take loan from the bank asks you say 8% of interest rate, and bank gives you a deposit interest rate, right? Interest on your deposit say 6%. So it is always lesser than what you pay, right? Yes, RBI pays to the bank, so it will be always less than what RBI receives from the bank, isn't it? So very commonsensical reason behind it. So this is how you can remember. You can go on the official website of RBI, you can check the policy rates, they will be like this only, the difference of 0.25%. Since RRR also had to be less than repo rate by 0.25%, but since it has now been fixed by the RBI at 3.35, as far as I remember, you can check it. So it would be 3.35 because now you have SDFR in place of RRR, so that would be 6.25. Is this clear? Now, the author says that there have been anomalies here. What anomalies have been here in all these things when we are analyzing this liquidity framework? That we have seen net deficit levels of say 1 to 1.5 trillion rupees on a daily basis in the banking system. So on the daily basis, you have had deficits of around this much amount, okay, since April. But yet what happens is some of the banks, their bank surpluses have flowed into SDF, your standing deposit facility. So what editorial or the author is trying to highlight here, that the entire banking system is not going into the same direction. Are you getting my point? The author is highlighting that since April, RBI has reported daily basis deficits of 1 to 1.5 trillion rupees. On the same time, you have certain banks which have surpluses. So when you have surpluses, you can park them with your Reserve Bank of India through SDF, standing deposit facility, so that you can earn interest upon them. Yes, you will get the PDF. Okay, let me tell you one thing. You get the PDF of all these presentations after the class on the same day. Okay, so there is a Telegram channel. You can join the Telegram channel which has been pinned in your 23rd May's class. You can go and join the Telegram channel via that link. Is this clear to you all? You will get the PDFs after every class. That is for sure. Okay. So in 23rd May class, it is also pinned in the class, the Telegram channel, which you can join to access the PDFs. Okay. Now, क्या कहना चाह रहा है समझ नहीं आ रहा, ये author क्या कहना चाह रहा है. See, I am trying to explain that thing only. Author is saying that the entire banking system is not reeling under crisis. At the first stance, okay, I am explaining to you. I have not explained what the author is trying to say. That's why this was a very complicated editorial, okay. But at the end, you will get to know what the editorial was trying to tell you. This is why we have these kind of analysis. Okay, you can relate everything. What the author is saying is, you don't have generalized crisis in the banking system. One sector in the banking system is which is reeling under this deficit levels. First thing. Second thing, there are banks who have surplus as well. How can you say that? Because their surplus have flowed into SDF. You know SDF, standing deposit facility, to absorb excess surplus from the banks introduced by RBI, right? So in SDF, banks get higher interest rates. To earn interest rates, they have placed their extra surpluses with RBI through SDF window, which have been very buoyant, which has been increasing, very responsive they are, right? And you can say that they are lying in a range of say 60,000 to 80,000 crores. That is a huge amount. 60,000 to 80,000 crores. So some banks reeling under deficits, some banks keeping their surpluses in the form of SDF with the RBI, which is worth say 60,000 to 80,000 crores. So it is not the same situation for the entire banking system. Crisis है ये कैसे prove हो रहा है? RBI has data. RBI has data of everyday liquidity deficits or surpluses. Okay. So according to that data, you have data for everyday liquidity management. On that basis, the author is saying. Clear? Now tell me, is it clear to you what the author is trying to say in these 2 points? So basically, he is saying that it shows that the system is not one-sided. If you read this line, you will get everything, that the system is not one-sided. Some banks have surpluses and invest in RBI's overnight SDF, which has been introduced by RBI. That's why I earlier only explained you what is SDF, what all are these facilities, so that you can understand the analysis, right? For a return of 6.25%, what is the present SDF rate? 6.25, which we have recently calculated. Yes or no? So some banks are having their surpluses, so they want to earn this 6.25% interest by placing that extra surplus with RBI under SDF, while those with cash shortfalls, with deficits, are borrowing at 6.5 to 6.75. So they are borrowing at 6.5 to 6.75. What do we mean? We have Repo as 6.50, yes or no? And we have MSF bank rate at 6.75. So that's only what the author is trying to say. Have you got it now? Yes, you can use, okay? You can use it in your answers. It's just that whenever, if you are using any data, you have to authenticate that data. That suppose repo, so you need to know that you have to mention from RBI's website this, okay? The source, you have to mention the source. For example, you are talking about inequality, and if you say that this percentage of inequality is there, what is the source of your information? Just remember this while writing your answers, okay? So have you understood now? ऑथर पहले के डेफिसिट लेवल बता देता तो पता पड़ जाता कि उसने क्या डेफिसिट होता है. यूज सी, don't get confused, don't get baffled. What the author is trying to say is clear in these points. First thing he is saying, some banks are having surpluses, so they want to earn this 6.25, which is your SDFR. And why is it your 6.25? You all know that would be always 0.25% less than repo. And some are running into shortage, cash shortage, so they are borrowing at these rates, 6.50, this is 6.5 and 6.75, which is what? 6.5 is your present repo rate and 6.75 is your maximum rate, which can be your bank rate and MSF, isn't it? Which we have recently tried to calculate. Yes or no, you agree with this? Through the VRR and MSF windows, again also mentioned here, right? So he is saying a close picture is difficult to get. A close picture is difficult to get. That's why managing liquidity in the money market is important. Why? Because you don't have a generalized situation so that you can say, okay, entire banking system is having surplus. Need not worry about that. No. And you can also not say that entire banking system is running under deficits. No. You have to find the way in between to manage both the ends which are prevailing in your economy or your money market. This is what the author is trying to highlight. And it is also linking it with as a contrast with your government cash balances, which have recently increased. So the entire picture till now is clear to you. I hope that, right? Although it was difficult, but I tried to make the interlinkages and try to explain you the basic concept so that you can understand what the analysis is talking about, right? Okay, so now author says that under these circumstances, when you don't have a clear picture that the entire banking system is running into deficits or surpluses, you have gray, you don't have black and white, right? You have grays in your money market, your liquidity adjustment. In this case, RBI has maintained the liquidity situation in market quite adroitly through its framework. So RBI has been very prudent in managing between these extreme situations. You cannot leave banks with very much surplus. You need to transfer that surplus to the money market, to the say economy in form of loans to manage the money supply. Also, you cannot leave your banks with higher deficits. That would create a crisis, a possible crisis in future for your economy. Yes or no? So RBI has very prudently through these LAF windows. So basically this is an analysis of VR and VRR, VRRR, variable rate repo and variable reverse repo, that why RBI has introduced these tools, why is it using these tools for a long-term adjustment in your banking system. This is how you can avoid these extremities, right? Also, the author says that a new twist has been added to this entire scenario with the announcement of buybacks of government securities. So at the first end, you are trying to manage the liquidity in the market. Just try to understand the contrast which has been highlighted, which is being prevalent in the Indian economy right now. Contrast the author wants to highlight is that at the first end, you are trying to manage the liquidity in your banking system. On the other hand, You tell me, first of all, you tell me, who buys and sells the government securities on the behalf of the government of India? Who is the authority to do that? It is the RBI. Right? So, government has decided to buy back the government securities. What does buying back government securities mean? So, when you sell securities, what happens is, when you sell something, you receive the money. So, when government had to borrow from the market, RBI sold the government securities, something known as your open market operations, right? Selling and buying your government securities. So, when you sell, you absorb the money from the market because you wanted loan, okay? Yes, but when you are buying back, very good, you are injecting the money back into the market. You are injecting the money back. Now, why government has decided to buy back? Although RBI will do that, but the decision is of the government, because now, as I earlier told you, that the government is having some good cash balances due to reduced expenditure. What is the reason? The ongoing model code of conduct. So, reduction in expenditures. Another thing, higher dividend received from the RBI, 2.11 lakh crores. Right? So, it wants to reduce its debt burden. That's why I decided to buy back the securities. So, it will again inject the money into the market. Isn't it? Yes, it is a windfall for the government. Right? So, it has decided to buy back the securities. Now, this is happening at a time when government cash balances are somewhat high and liquidity is under some stress. Okay, the buyback formula being adopted today can be interpreted as government withdrawing its debt by using cash balances. So, government is trying to reduce its fiscal deficit basically, isn't it? Can you relate this point to fiscal deficit? Reducing your debt, fiscal deficit is nothing but your borrowing liabilities. Yes or no? Agree? So, government is trying to reduce its fiscal deficit through buying back the government securities. Because fiscal deficit amounts to your borrowings only. You had deficits, that's why you had borrowed from the market, isn't it? We have explained, we have learned the entire mechanism in previous classes. Yes, very good. Now at the end, the author says that all these things are going on, so an alternative could have been there as well, to just hold back on weekly auctions. So, author is saying government could have decided not to buy back the securities, suddenly. That could have been done in installments for a shorter period of time. Okay, why the decision is sudden for all your government securities? So that the market can get clear direction, clear injection of money. Are you getting this point? But in that case, messaging would have been different. A bond buyback conveys immediacy and sends a strong signal to the market that okay, we are injecting money back into the market. That would give your banking system liquidity. That would give your money market liquidity, which is RBI trying to manage through its LAF window. Okay. On the whole, RBI has brought a lot of dynamism to the money market. Okay, with tools being used to manage liquidity in a non-disruptive manner. Again, the same point which we have started this presentation, that the RBI is managing in between all these things. Government decided to reduce its own debt burden, injecting money into the market. RBI has to manage the money supply, finally. Right? So, the author is saying that this is why RBI has introduced a lot of tools like this VRR, VRRR to manage the liquidity in your money market, because it has become very dynamic. Government is now also affecting the money market liquidity available to you, isn't it? That's how trying to get a balance between your fiscal policy and monetary policy becomes important, because your final aim is not fiscal policy or monetary policy. Your final aim is economic stability along with growth. That stability can only be witnessed if you have enough liquidity in the market with lesser fluctuations. One hand government trying to do its own thing, other hand RBI trying to do its own thing, but RBI has managed to find a way in between to manage these extremes. This is what the author is trying to say. Is this clear to you all? Now let me take back to this first slide. Why did I put this title? Liquidity and the slopes. So basically in Indian economy, the trend or the motive of this editorial analysis was to make you understand that in Indian economy there is no one slope. You cannot say that liquidity is declining or going in one way, right? So liquidity is changing its slopes in the economy. That's why I chose this title. I made this title for this analysis today, liquidity and the slope. Sometimes it is going towards the government, and when government decides to buy back, it will go to the banking system. This is how it is changing slopes. In this duration, in this time period of liquidity changing its slopes, the RBI has to be very prudent in managing these fluctuations so as to protect your banking system from crisis or from excess liquidity. Now tell me, is this clear to you now, what the editorial talked about? It must be clear now, okay? I hope so. Although it is a complex analysis, but it is easier. You just, I try to wrap it up in simpler words so that you can understand. Clear? I hope you have understood this analysis of today's topic, okay? So this was from your Mint. Other editorials were not relevant. There were political inclinations in them. We don't have to do about that, what the BJP has to do with inflation, what the Congress has to do, right? Alright, I hope you'll find it useful. You can use these instances, these analysis in bringing solutions to the ongoing problem which are asked in your examinations, right? So you can quote these things in your answers. I hope that was useful for you today. That is it for today's analysis, and I'll see you with many more such editorial analysis in future. So I'll see you in the next session. Till then, I wish you a very good day. Thank you so much for staying tuned, staying focused. Thank you.